Let's think back to when you were 18. You want to move out of your parents' house. So, first thing you do is you go down to a local apartment. You fill out an application. The first thing they do is they pull your credit. While you're living out on your own, you need a cell phone. So you go down to the cell phone store, try to get a cell phone. First thing they do, they pull your credit. You need to get a car to get to and from. You don't have your parents to chauffeur you around anymore. So you go to the local bank or credit union, and what's the first thing they do? They pull your credit. In today's world, almost everything revolves around credit. Companies are in business for profit, and credit is one of the main reasons or the main ways that they can ensure that they get paid, that they get repaid for the money that they're lending. My name is Albertson, and I am currently employed by Idaho Central Credit Union. I am a mortgage loan officer, and I see daily the impact that credit has on our everyday lives. Today, I will explain what credit is, and then I will explain why it is important to us and how we can obtain it and maintain it. So starting off, what is credit? Credit is a nationwide risk grading system. It's reported by three major companies, also known as bureaus. According to Equifax, which is one of the three main credit bureaus, credit is a system that's designed to represent your credit risk or the likelihood that you will pay your bills on time. In general, a higher credit score represents a higher likelihood of responsible financial habits. So, in short, credit is how likely are you to pay your bills. How is a credit score calculated? On the website for Experian, one of the other major credit bureaus, we find that credit is broken down into 6 major categories. The first being credit history, so how long your accounts have been established. The second being payment history, so how well you have maintained your current obligations, your current debts, how well you have actually made the payments. 3, public records, if you have like any bankruptcies, judgments, collections, or anything like that that's reporting on your credit. 4, utilization rate, so how much of your credit limits are available and how much you have used of them. 5, new account, so how often you're creating a new credit account. And 6, the number of inquiries, so how many times people are checking and verifying your credit. Wells Fargo, one of the largest banks, breaks down on their website the different weights and how each category is broken down. The first main important category is going to be payment history. 35% of your credit score is dependent on payment history. So how well you've paid on your obligations. Like I mentioned earlier, your credit is based on, your history, or businesses are in a business and they're in it to make money. And so how, the overall point of credit is to determine how likely you are to pay your bills. Number 2, 30% of your credit score is dependent on current loan or credit card debt. So how much of the credit that's been extended to you, how much you are using of it. 15% of it is dependent on the length of the history that you've had, so how long you've had these accounts established and open in your name. 10% is dependent on the types of different credit that you have, and the other 10% is dependent on new credit, so every time you get a new account. So why is credit important? Credit's important for financial reasons. When you apply for loans, they're going to check your credit. Your credit is going to be dependent on the rate that you get and how much money you pay in interest. When you get a new job, they're going to verify your credit. If you have a lower score, that could be a possible deterrent to a future employer. They verify your credit for new services. So even when you're not applying for a loan, if you go down and try and get utilities in your name, they're going to verify your credit. If you go and get a new cell phone, they're going to verify your credit. If you go to get insurance on your car, they're going to verify your credit. How do you get credit? Credit is kind of a catch-22 because you need credit to get credit. But most financial institutions will kind of give you a starting trial period. They can give you a small limit for, like on a credit card. Sometimes you have to secure it with your own funds. Sometimes you don't. Also, starting young and just building off your credit is another way, and just taking your time. You know, credit is one of those things where it's not a quick overnight fix. You can't go from having no credit to credit overnight. So once you do have credit, how do you keep a good score? And then how do you better your credit score or get a better credit score? The most important, like we talked earlier, is just making your payments on time. You know, if you're constantly making your payments consistently, you're going to have a decent credit score. Keeping your card balances low, so 50% of your limit is what the credit bureaus recommend, but 30% is ideal, and it actually builds your credit more. If you have any collections or judgments, pay those off. Don't pull or check your credit score often. And then overall, just take your time with credit. In conclusion, credit is not just for loans. It's for everyday life. Like I mentioned earlier, you need it for everything. A low score can really make your life hard, but on the flip side, a good credit score can really make your life easy.